How did the experts and regulators miss this disaster? This video will focus on the mortgage crisis that is unfolding in Australia, but no matter where you are in the world, you can learn valuable lessons from this video and apply it to any situation. Watch to the end to find out how. Hi, I'm Huiming and I have almost 15 years working in the banking and finance sector. And in this video, I'm going to reveal how this crisis came about and more importantly, how you can avoid it. Imagine you're trapped in a mortgage prison. You can't get a cheaper interest rate on your home loan because you don't qualify for today's tough lending rules. And you can barely afford the repayments because interest rates keep going up. 1 in 6 borrowers in Australia are facing the same problem and it could get worse. The Reserve Bank predicts that if rates go up by another 1%, the numbers will be 1 in 5. And most of the people who are mortgage prisoned are first home buyers who borrowed too much during the pandemic. Why did this happen? To understand the origins of this crisis, let's travel back in time to 2014 when Australians were drowning in debt and buying property like crazy. To cool things down, APRA, who is the watchdog of the financial services industry in Australia, and a new rule for lenders. Lenders had to make sure potential borrowers could pay their mortgages at an interest rate of 7.25%, even if their offer rate was much lower. This is called the interest rate floor. Before I explain how this works, you first need to understand what a serviceability buffer is. A serviceability buffer is the extra interest rate that Australian lenders add to the offer rate to check if someone can afford their mortgage repayments if interest rate went up. In 2014, this serviceability buffer was 2%. APRA's new rule meant that Australian lenders had to use a larger number to assess whether a person could pay back their loan, either the interest rate floor of 7.25% or the serviceability buffer of 2% above the offer rate. And why did they do this? The aim was to stop people from overborrowing and risk defaulting in case interest rates went up. So this new rule protected borrowers. Before we move on to the story, let me tell you 2 key facts about APRA. Officially, APRA members are chosen by the Governor General. But the Governor General is just a ceremonial representative of the King and has no real power. So APRA members are chosen by whichever government that wins election. And guess who pays for APRA's operations? The very same industries that it's supposed to regulate. Wait, you pay me to regulate you? Yes, that's correct. How does that work? It works for us. Now, APRA is unique to Australia, but does this sound familiar to you? Have you heard something similar where you live and you have a gut feeling that something shady is happening? Getting back to our story. 5 years after APRA introduces the interest rate floor of 7.25%, Scott Morrison wins the election and becomes Prime Minister for a second term. And 2 days later, APRA's chairman scrapped the rate floor. Coincidence? I don't think so. The chairman at the time did this because the economy was tanking, inflation was low, and the cash rate was decreasing. And more importantly, banks were losing money because they couldn't lend as much as they wanted to. But he didn't say that. He said he was doing it for the borrowers to increase their borrowing power. Of course. Borrowing power. And then he did something worse. He let the lenders decide their own interest rate floors. APRA did try to rebalance the scales. When they removed the rate floor, they also increased the serviceability buffer from 2% to 2.5%. But that didn't prevent what happened next. And what happened next is very alarming. In less than 18 months after the rate floor was removed, home lending in Australia almost doubled, with a shocking number of people borrowing more than 6 times their household income to buy property. APRA's answer to this runaway train was to increase the serviceability buffer from 2.5% to 3% in October 2021. But it was too late. Thanks to APRA's removal of the floor rate, people borrowed more than what they could afford. And then the nightmare started. The cash rate skyrocketed from 0.1% to 3.85% in less than 2 years. That's 11 interest rate hikes. Between the time that this video was recorded to its release, the cash rate in Australia has increased again and now it's at 4.1%. And the average mortgage went from 2% to 6%. Imagine the shock and stress for the people who took out massive loans at a time when interest rates were at an all-time low. These households were only tested for a buffer for around 5%, but now they're paying 6% or more, and it's likely to go up higher. Their income can't keep up with inflation and interest rate rises, and they're drowning in debt. This story goes beyond Australia. Wherever you are, this story has implications and insights for you, especially if you dream of owning property. You need to know these 3 things before you buy a home. Firstly, the economy is like a roller coaster. It goes up and down. You can't just focus on the present, but also the unavoidable economic changes that will happen in the future, especially when you're deciding on a long-term financial commitment like purchasing property. Secondly, the people who are in charge are often playing catch-up. They try to speed up or slow down the economy depending on the situation, but their solutions often create more problems later on, which they then try to patch up with more band-aid solutions. Lastly, the politicians have the final say. They decide how regulators do their job and how institutions like the bank conduct business. But politicians have too many things on their plate. They have to balance many different and sometimes conflicting priorities. Oh, and they also have to worry about getting re-elected. So they might make policies that sound good now, but cause issues later. So you can't trust banks, regulators, or the government to tell you how much you can afford on your home. You need to figure that one out yourself. The good news is that you only need to focus on one thing when it comes to your finances: yourself. So there is no conflict of interest. You're the best person to make smart financial choices for your future. You need to stress test your own finances and see how much you can afford and how you can cope during economic downturns. Now, this might sound really empowering or really scary, depending on how you feel about money. But finances don't have to be complicated if you know where to start. If you dream of owning your own home and don't want to bite off more than you can chew, then tune in to my next video, where I will share some guidelines on how you can figure out whether you're financially ready to purchase your first home. Thanks for watching.